Hi, guys. Welcome to another episode of Finance Talk, where we speak about finance, business, and investing. I'm Eugene. I have more than 10 years of experience in business. I also interested in finance and building my own portfolio and hoping to set up a fund in the nearest future.
And I'm Nick Rational. I too have a lot of business experience and been doing the investing for a while now. Together, we're going to share with you what we have learned, and together we can all learn more and become greater investors. I too hope to start a fund in the near future, and let's all learn together.
So, what will be our today's topic, Nick?
All right. So last episode we talked about zombie stocks, and we talked about sin stocks. And we also spoke about the Altman Z-score. These are ways of protecting yourself and not making bad choices when you buy the companies you buy. These are just a few of the things. So today I wanted to talk about value traps, which are basically you see something that looks like an incredibly good value. It's trading at a much lower multiple or something like that. It's basically a poor investment because the reason for the low price or low multiple is some kind of actual financial instability. Maybe the company doesn't actually have the growth potential that it used to, but it fools us value investors because of how it displays. And so this is really an important one to look at because it can be quite misleading and you think you're onto something, but actually it's a value trap. Let's move over to Eugene and see what he has to say about value traps.
Yeah, this is a really interesting topic, and especially for beginner and intermediate investors, because you can get to very interesting stuff, and you clearly can see that this stock is undervalued, and it seems fine with the numbers and all this thing, but the stock is still undervalued. And you're trying to buy and you purchase the stock, and then after some time, everything will go not according to your plan. And as a result, most people just say that stock market doesn't work. It's like the gambling, and it's not for me. So what's the reason? I think there are several things which we need to consider when we analyzing the company and the stock. They can be divided into first like technical indicators, particular events or news about the company. They can be connected to the management and the industry. So let's start with the indicators about the company and understand why these are so important things to consider and how we can just go away from such kind of value traps. So first of all, P of 1 or price to book 1 or something similar which is close to 1. And most people just hear into interviews and they hear from popular investors that you need to look for companies with a P of 1 or 2. And they go to screeners, they run these filters, and they found several companies which have like P of 1 or 0.1 or 0.5. And they think that this can be a great thing. But in most cases, either these companies have like either received the money, so they do not have a lot of history behind them. So it's like the venture capital startups, or they have some differences in the current assets, in debt, or in something else. In this case, you need to consider the whole picture in general and look only on one particular indicator. What do you think about that, Nick?
I agree. And to put it in my own words, the value trap is essentially a trap not for value investors. It's a trap for value investors who don't want to do enough research. The number one sort of protection against a value trap would be research, to understand why is the market pricing this so lowly. If it's been undervalued for many years, to me, it's almost that alone is almost an indication of a value trap, because how would the market miss a great amount of value for a great amount of time? To think that you're smarter than everyone else by doing a simple screener test and nobody else did that screener test would be a lot of hubris. To think a lot of yourself. Always make sure you know why something is undervalued. The why is more important than the fact that it's undervalued. There are tools out there that can help you find value traps if you're really worried about it. I think there's some spreadsheets you can purchase that will help you to determine, but you'll never really be able to determine 100% of the value traps just with these tools. The company looks undervalued, but maybe it's actually accurately valued. And when you buy into these value traps, the real risk is that it will go sideways for a long period of time, or maybe even go down. And so it's essential that you do your research.
In most cases, value traps are long-term game. And when you just want to be a value investor, you probably would buy and own stock for 2 5 years. And the reason and the main problem with these value traps that in this particular time, like 2 5 years, you will see that something is not going well with this company, and you won't understand why. So that's why these are value traps and they need to be considered in the analysis. So the next part are indicators which are connected to the news about the company. And it's not about the particular news which do not affect the numbers of the particular company, like we discussed previously. But this can be the news which really hurt the company in the nearest future. For example, like the differences in tariffs, economic downturns, or raising the inflation, or something similar. Because this proves that, first of all, the company doesn't have enough stable situation on the market. Second, its business model is not so unique or proven. It has some weaknesses. Third, that probably there can be some difficulties with the management and inside of the company. So what do you think about that, Nick?
You're pointing to definitely the right things to look at. For example, if a company doesn't have enough of a moat, then they won't be able to maybe raise prices alongside inflation. Or if they don't have enough health in the company, in other words, maybe they don't have enough margin, profit margin, they can't lower their prices if necessary. Or if their costs of production go up and they can't raise their price, their profit margin disappears entirely. And so these are kinds of things, the moats and the profit margin, the health of the company, that you really need to dig into and see. Maybe this is why the company is undervalued, is because it's not actually undervalued. It's in line with the risks and uncertainties of this company. Research is really the cure, I would say, for worrying about the value traps. But you definitely want to make sure what you're buying isn't a value trap. One of the things you said, I think, indicated you want to be able to tell that it's an event causing the low valuation, by the market, that the actual value of the company is still high. But if you can't identify that event, it might be a value trap, because you want to make sure that the value of the company is rock solid and that the price is lower. You don't want to be buying because the price is lower and hope that the value is still there. You need to know. Back to you.
And the way the market works is that you're playing with really big guys. And these guys have like billions of dollars, and they have MBAs and all these degrees. And they have a bunch of analysts who watch after the company every single day from morning to dark. These guys really understand the macroeconomy and just economy. And when they see that the company has like unstable business model or unstable profits, or there are several news and events which can hurt them, they can really affect the stock price. It's not about us like value investors, because we manage much less money by ourselves. So our decision will not affect the stock market or the stock price significantly. But these guys really can make the point. And that brings us to the next point, and the next reason why most companies can be a value traps is the problem or different problems with management or with the laws. Consider this situation that you looking for the company, so the numbers are great, it's undervalued, the business is good, the industry is rising, etc., etc. But the CEO is under arrest, and there is some law enforcement by the management, and this can really affect the company, because this management can be the fraud, or this management can be the people who do all the work, or one person can bring so much value to the company that if he goes away, the business is done. Sometimes when you just analyzing the company, you do not consider, and most people do not consider such effects and such situations. So as Nick said, you need to be very careful with the analysis.
Point to consider with regards to this is that for the larger the company, the larger the market cap, the more likely on average that the the company will be accurately valued. Large cap companies sometimes have 50 different analysts trying to determine the value. And then small cap and medium cap will have less analysts. Some companies have no analyst even following them, or just one analyst. And so, and as well, the bigger companies have more institutions and big investors investing in them and figuring out their value. And the smaller ones are so small that they're kind of ignored. You might be able to find mispricings more easily on the lower cap, but there's also more risk and volatility with those companies. And on the higher cap, it's less likely that you're going to find a mispricing unless there's an event, which is where there's fear or undue hype. It does get overvalued and undervalued on the big companies, but on average, they're going to be better priced accurately on average. And so if you're finding something that looks like it's been undervalued for a long time and it's a large cap stock, the odds are that you're actually wrong. If it's been undervalued for 5 years, you got to ask yourself, if it's a large cap company, how did the 50 analysts miss it? How did the institutions miss it? Are you really that smart? So on the bigger companies, you really got to ask yourself, how long has it been undervalued and why? And if it's an event that you can identify, then you might be onto something. But if it's not an event, be very wary of calling it undervalued. And if it's a smaller cap stock, you've got other risks to consider. But that's my thoughts on that.
Yeah, that's great that you mentioned that. How can it be possible that 50 analysts who follow the stock and the company can be miss something and the stock is undervalued? This brings us to the next point, which is connected to the industry. And usually you need to be really careful about that because currently I know there are several companies and several industries which can be undervalued, especially cyclical businesses. So when you go and see like the shipping company, which is trading like 0.5 PE ratio or 1 price to book ratio. And it seems like undervalued. And you saw that last year it made a lot of money. And probably you found something and the company is undervalued. But you invest in the company and something goes wrong. So why is that? It's because not many people just understand the business and understand cycles. Because usually institutional investors understand when to enter this cycle on the bottom and then to when to go away from this cycle. And usually retail investors do the opposite. So they enter the market when there is a high level of this cycle. And there is a high probability that they can lose their money. What do you think about that?
I think that as an investor, there's several tricks you can do to prevent this kind of a mistake, but also there's a duty to know your industry, know what kind of thing you're investing in. So if you're going to invest in a cyclical company, a business that does very well in November but terrible in February, that kind of a business, cyclical, you need to research those kind of companies. You need to read books on. They're incredibly hard to value, in my opinion, versus a regular stable business. Cyclicals are really something. But I mean, every kind of unique kind of business you really need to dig into. Make sure it's in your circle of competence. So that's your duty, is to understand the business you're investing in. Make sure it's in your circle of competence. Make sure you understand cyclicals if that's what you want to get into. The tips and tricks I was referring to is always compare the finances and metrics that you're looking at with the top competitors in that niche to see how they compare. If you're looking at a 0.5, on the book value kind of metric, make sure that the competitors aren't the same, or others, or even the industry as a whole. See what is normal. Is it really underpriced, or is that exactly the same for the rest of the industry? So that would be one of the tricks, is to always compare like for like. It's kind of like when you're trying to value a house in the market, you do a competitive market analysis where you compare it to similar houses in the neighborhood that have sold recently. That's how you determine the price as accurately as you can. And it's the same with valuing businesses and looking at their metrics. Look at the neighbors in that same industry. Back to you.
Last but not least point of how to identify or how to know that this potentially can be the value trap is the situation when the company promises and pays high dividends. And it's close to dividend traps, especially when the company doesn't have enough resources for that. There are really rare situations when The company pays dividends and it's negative in net cash flow and net income. But the company still has cash on hand and it continues to pay dividends. And in these cases, there is a high probability that this company is the value trap because it doesn't make enough money to sustain the growth and to actually exist because it is negative in net income. But it pays higher dividends, and these dividends can be higher than the industry average. So it attracts retail investors who trust this company and they think that they will continue to receive these dividends for a certain period of time. They invest significant portion of their money into this stock, but eventually something goes wrong. What do you think about that, Nick?
It reminds me of a horrible, fairly recent example where a major company was paying dividends for 30 years, never decreasing the dividends, paying it stably, and hundreds of thousands of people were relying on that for their retirement, and it was part of their dividend portfolio, and they were relying on it. You know, elderly people who counted on that money, and they counted on their principal being safe with that company. You know, all their life savings were with that company, and that company kept on paying, even though it was going through such horrible times. Its cash flow was terrible, profits were terrible. It couldn't afford those dividends, and yet it continued to pay them by simply increasing its debt. They would borrow money from the banks to pay those dividends, and the company was in worse and worse financial state year after year. And they never said anything in the annual reports to warn investors. And eventually they went bankrupt, and a huge amount of people lost a huge amount of money. So stable dividends for years and years does not mean a healthy company. Always look, is the debt increasing? Do they have enough money to pay those dividends? Don't end up being part of a horrible example on someone's podcast. Make sure your companies are healthy. Back to you.
Still, you need to recheck every information you see and read in the internet. It's the same with us. So these videos are not the financial advice. We just say what is our own experience and our knowledge. So you need also to recheck them if you are really curious about the investing and business in general. But anyway, we try to present as much accurate information as we possibly can. This is the end of this episode. We hope you really enjoyed that. If you have any questions, please write them down in the comments below. We also invite you in the Discord chat where we share information about the stock ideas, guru picks. See you next time.